Good afternoon, everyone, and welcome to Stock Market Today. It's Coram and Ed Carson here with a breakdown of the action in today's session, where we saw a bearish downside reversal to cap off the week.
Yeah, it was a pretty ugly day to end sort of an ugly week. Market's still under a lot of pressure. I want to take a look at Apple and Arista networks, compare the two. Neither one of them is actionable, that's for sure. Also look at Enphase, which is one of the leaders in this market.
All right, we'll get to those, but first let's take a look at the major indexes after initially a positive reaction to the jobs report, and you can fill us in there on how that turned out, but we did end up lower for the day. The Nasdaq, the hardest hit, down 1.3%. The S&P 500 and Dow down about 1.1% apiece. The Russell 2000 not too far behind, down 0.9%. So with an upside reversal on Thursday, the thinking was, okay, maybe that'll give us a little bit of momentum into Friday if we can continue the gains, but that didn't last for very long. And that reaction to the jobs report was definitely the wild card that prevented us from getting too excited Thursday afternoon, especially with how we're below key technical levels.
Yeah, if you could bring over the S&P 500, I think that really illustrates the issue here, is that on Friday, we came right up to the 50-day line, and we did it also on the Russell. The Nasdaq didn't quite get there, but we came right up there. I mean, there were some news items that maybe, Russia's going to keep the natural gas pipeline off, though natural gas sold off pretty sharply in the U.S., so don't know what to tell you there. So it just, we sort of came through the 50-day line pretty much like butter, but now it's a ceiling. I mean, we're not coming up through it the same way. So it didn't act as support, and now it is definitely acting as a ceiling. That's an issue. And you can just see the S&P was sort of the trigger a couple of weeks ago when we hit resistance of 1 point from the 200-day line. So that was really negative action. That's coming down quite a ways. The S&P undercut its late July lows. The Nasdaq, I think, just avoided it today and yesterday. That's pretty much like the last stand for the market rally. But clearly, we're in trouble. So we're selling off on bad news. We're selling off on good news. It's selling off. It's not good conditions, and we need to see that turn up considerably before you get excited. The 50-day would just be the first test.
Exactly. I mean, charts matter. This goes to show all these levels that you're pointing out, Ed. We can't predict the future, but utilizing these charts is the closest thing that we have to being able to do so and really having that edge, but just being able to sway with those conditions and to be able to maybe react faster to the changes that we are seeing in real time.
Yeah, I mean, we were on IBD Live this morning. All the panelists were like, until we get over the 50-day line at least, and not really until you get over the 200-day line where you get really excited. There's just not a lot of reasons to be excited in these kind of conditions, especially with the macroeconomic background that we have.
Well, let's also take a look at the Dow and Russell 2000 downside reversal, big outside bar here as well, hitting resistance right around 32,000 for the Dow. IWM, this is the ETF tracking the Russell 2000, bumping its head up against the 50-day line and reversing lower. Also, let's take a look at 0TNX, the 10-year Treasury yield, coming off a bit on Friday, but if we take a look at the weekly chart, there's a lot of up weeks in a row here for the 10-year yield.
Yeah, and that's been a real story. That's a big reason why the market has been struggling so much. You can withstand a day or two of the yields going up, but it's really hard to withstand this kind of action.
So with the yield falling today and the market falling, is that doubly bad? Because if yields coming down is a bit of relief for the market, I mean, it's never a one-to-one, inverse relationship. But what do you think about that?
Yeah, I think in Jed Graham in our A1 story, he quoted somebody near the bottom of his story talking about how the Fed is basically not really trying to do a soft landing, but almost an emergency landing, is that the market is now shifting from any news is bad news. It's almost because it's the amount of negative news you would need to get the Fed to stop would be really bad for profits, for for the economy. So that's not great. Today's jobs report, strong hiring, maybe too strong for the Fed's liking. There was a labor force gain. So Fed rate hike odds did ease, at the margin. But yeah, it's just, there's not really any, not a whole lot of positive. The market is not in a mindset to rally right now.
And I feel like that's what makes it difficult for investors, because sometimes when the news flow is so bad, we do start seeing the market rally. So we want to be in step with the market day to day, but could you foresee a scenario where the news flow is still negative, but we are starting to rally? And we don't want to ignore those signs either.
Well, I wasn't surprised this morning when we bounced. It seemed like a report that would get the market to rally. And so, yeah, we certainly, if we saw the market rally on bad news, it would not surprise me. I was a little surprised by the reversal. I mean, not that surprised that the reversal happened right at the 50-day line if it had to happen, but I was a little surprised. But so if we do start rallying on bad news or good news or whatever it is, that wouldn't be too shocking. But yeah, we need to break that trend. The thing is that we talk about uptrends, is that because you expect things to continue that trend. You don't know, but you expect it to. And right now we're trending down. And when that exactly, you sort of expect it to continue, and you expect most stocks to continue to slump. So, maybe we are ending at the very end of ending a bear market rally and are going to head back toward the lows. That's something investors have to keep in mind. Yes. as we go forward. We don't know where we're going, but it's not the right direction right now.
You're absolutely right. And one more technical level that I want to show, we did close below this trend line here across the lows on the Qs on the NASDAQ, I'm sure as well, or perhaps similar action here. So just yet another level on the downside. We always like looking at levels on the upside and downside, see are things within our expectations, breaking expectations, just to get a gauge of where we're at. So just another little tidbit for everyone there. And let's also take a look at some sector action. So here's a look at XLE, up 1.9% on Friday. For the week, down 3.4%, breaking a 3-week winning streak. Just when we were starting to see some of these oil and gas stocks clear early entries or handle buy points, starting to look actionable, even though perhaps maybe from later stage bases, seeing a number of them coming in this week.
Yeah, I mean, that isn't necessarily the worst thing, because you can imagine a lot of charts forming handles here, maybe the 50-day line or 10-week lines catching up. But yeah, I mean, that's the thing. These stocks have a lot of volatility too. There's a lot of things going on. Oil and natural gas prices both fell this week, and there were some big swings daily and intraday at times.
All right. And next on our list, let's check back in on chip stocks. Here's a look at the SMH ETF. Pretty bearish week here, down about 6.7% for the week, slicing below the 50-day and 10-week line here. So a pretty pronounced chart that's looking damaged in a pretty big way.
Yeah, I mean, there's some negative news about NVIDIA getting some chip sales banned to China, but honestly, this was selling off well before that. But NVIDIA's at new lows. The leading chip stocks, almost all of them have broken down. I mean, there's one or two that may be hanging on, but a lot of those that were looking really strong.
Yeah, that's a really ugly weekly bar here.
That is a really ugly weekly bar. And if the chips are struggling, that's a bad sign for the market. It's hard to see the market rallying if chips are not at least participating. A week or two ago, we were like, hey, there's some chip stocks participating. Yeah. We're going here. And then, but that clearly is not. And so, you have to reassess. It's like that is another negative sign for the market.
And another good thing to keep a pulse on is how speculative growth stocks are doing. So here's a look at the ARKK ETF for the week, down over 5%. Not the biggest weekly bar in recent weeks, but percentage-wise, still a very solid loss.
Yeah, and then with this and with NVIDIA and things is that, the bottom feeder rallies. I mean, the rallies, there was a big rally off the lows. I mean, if you bought one of these lows, there was a huge gain in ARC and NVIDIA, and some names were doubling. I mean, and not, but you can see how much of these gains are now coming off. So it's, again, the tide has turned quite a bit. Just a lot of negative action. I mean, thing is, it's not even to pick on ARC. There's so many things that look negative this week. Major indexes, sectors. There's not many leading stocks that are holding up. It's a tough environment now.
Right. Because, yeah, if bottom fishing is the strategy that some investors wanted to go with, hopefully taking quick profits was the other part of the equation there, instead of, all right, I'm gonna buy on this huge destruction and then just hold, because that is not working out.
No, it is not.
All right, let's take a look at some stocks, Ed. So kicking things off with a look at Apple, which for a number of weeks was looking pretty impressive. A nice winning streak there. It's been pulling in. Looks like it's now closed below some key support levels, down 4.8% for the week in increasing volume, the first above average volume in a number of weeks as it's carved the right side of this base. Going on over to the daily chart, we can see it's hanging around those moving averages, but the downside reversal saw resistance at that round number at 160 at the 200-day line. So this one's been pulling in pretty quickly and round-tripped all of its gains from a potential early entry on earnings, with it retaking that 200-day line and then some.
Yeah, and so those are all. So why were we looking at this thing? Well, one is that they are going to be in focus. They're going to come out with the iPhone 14. Will be announced on Wednesday. Another thing is that look at that relative strength line. That's actually holding up pretty well. See, this is, I think, a good reason why we always talk about, look, people don't like to talk about it when it's like when things are moving higher. My stock is the greatest. Well, chances are the market's going in the right direction too. I mean, you may have a stock that's outperforming, but it's working. Apple hasn't really faded off, though. It's not really Apple's fault. It's the market coming down. And so this just really illustrates that. It's like, yes, when the market's weak, even stocks that are sort of leading, this wasn't like blazing a trail.
But still, that was an impressive move.
Yeah, it was a nice uptrend. It was at a new high for the RS line there. I mean, it wasn't surging like some, but it was doing pretty well. I mean, it could still bounce back. Look, if the market improves, all of a sudden, this is something that you might start talking about as it gets above the 200-day, above the 21-day line. There's still some work to do there. That's a pretty steep downtrend. There's also they also have slowing growth. That's something, an issue. There's reasons to be concerned, but one reason to look at is just that this is the market has clearly taken hold of this stock and brought it down. And it's something to note that even a stock like Apple, when the market sells off, this is gonna feel a lot of pain too.
So we could see some potential catalysts here for Apple debuting some new products. We'll have to see if it can find support around this 50-day, 10-week line, but there might be some better looking fish in the sea. What do you think, Ed? Let's compare Apple with ANET.
Okay, well, ANET is not actionable either. Let's make that clear. I want to make it's showing a little bit better action, just a little bit. It has a handle as well. It's come down below the 200-day line. It didn't quite come to the 50-day line. I think on a weekly it was like pennies from the 10-week line. But so it did a little better technically there. RS line showing similar. It was basically right around high. So there's a lot of similarities in that chart, maybe just performing a little better. I guess I'd also say the fundamentals are a little stronger, well, definitely a lot stronger, that accelerating growth for a few weeks, few quarters now on earnings and revenue. Solid growth this year, pretty decent growth next year. I mean, there's always the risk that business IT spending crashes on you and that, or Facebook no longer wants to buy data center, those kind of things, which could happen. And, this one is also come down, but this one might look a little better than Apple. When you're looking around, you should be looking at other charts and say, well, which one would you choose right now? I think Arista looks a little better. Look, if Apple surges 10% next week, and Arista falls, I'm going to change my mind.
Of course.
But that's something that I think there's subtle differences that you want to look at technically and fundamentally that suggest maybe this one's doing a little better right now.
Yeah, I think that's a really great point, because I feel like that could kind of put you in check of, are you just having a bias and this is a stock that you just really like, or maybe you're seeing a lot of people tweet about it, or this and that, or you love your iPhone, or what have you, whatever stock it may be. Do that comparison and make sure that your everything that you like about the stock is really measuring up. And to do that comparison, I think is something that is quite helpful. Not only can you look at the price and volume action, but the fundamentals, like you said, Ed. And we also like looking at institutional sponsorships. Sometimes that, when we're comparing two stocks, maybe that is the tiebreaker, so to speak. But there are some of those subtleties too in the charts that is good to just keep an eye out for when you're doing the analysis for grading stocks, either in your portfolio or your watch list.
Yeah, absolutely.
And last but not least, let's take a look at Enphase, ENPH, one of the standouts in the solar industry group, down about 3% for the week. But Ed, this is a stock that is holding up quite well.
It's holding up quite well. I will say that it helps that when you're like 30, 40% above the prior base, then a 30% drop doesn't look so bad, as opposed to, I mean, if this had been setting up in a handle, it would be looking like an Apple and Arista after a week like this. So,
true.
I mean, there's always things. It's like a team that's 10-0, they lose one game. It's like, they're still a pretty good team. Holding around the 21-day line. So it's things like in another week on a weekly chart, they would have a flat base. I mean, assuming it can stay in this range, it looks like it's probably fallen about 12% from that high. So it could have a flat base. It's traded relatively tightly, especially when you look at how wild some of its action was before. It could come down to the 50-day or 10-week line. That's another alternative, or in conjunction with the base building, that could be a place where you might buy, because you could see this stock rebound off the 21-day line. It might be a little bit scary to buy that, especially because if that happened in the near future, that would probably mean the major indexes are just coming up to the 50-day line. It would just seem to be, it could very much be a similar situation where the market reverses again. So while in theory you could buy it, and then people might look in hindsight saying that was a brilliant move, that might seem pretty high risk in this environment. So maybe wait for a base, or maybe wait for that 50-day line, which is screaming higher. I mean, that would not take that many weeks.
Or day.
With them, or especially if Enphase, and that's also a risk too, is that it wouldn't be shocking to see Enphase tumble to that level. We saw Array, which is by no means the same institutional quality as Enphase, but that fell over 10% intraday. Now, the chart doesn't look that bad. I mean, it ultimately closed around its
intraday chart looks line. A little bad.
Yeah, that first 30 minutes or so, I was like, oh my goodness, what's going on? And that's when the market was up. That's when the market was up 1%. So I don't know exactly what happened. So there's always those risks that, that could happen. So the 50-day line might be a place to go for Enphase. So you just have to see right now in a tough environment, are these the stocks that are going to hold up, and then really blast off, or are we going to crack? Or is it going to be, another week or two of market conditions like this, and maybe that'll really, really falter?
Right. So, Ed, speaking of a tough week for the market, what would you say should be on investors' minds over the weekend, a long holiday weekend, I might add, just to remind everyone, the market is closed on Monday. But to prepare for the week ahead, what should we be doing?
Well, I think part of it is being a mindset. Be patient. Certainly next week, be patient. Don't be thinking, I want to jump back in, or things. It's just like, let's wait for the market to at least regain, say, the 50-day and 21-day moving averages to really even think about stuff. I mean, maybe the energy sector is a little different, but that's pretty volatile. Look, there may be some shorting opportunities, but I would build your long and short watch list. The short watch list only if we sort of moved up again toward those 50 lines. There was probably an opportunity, but it was so quick. We came up and came down, but it's something to consider. On the long end, build up those watch lists. You're going to have to change those watch lists from a week or two ago. And stocks like, say, Apple or Arista, which you might keep on watch lists, well, we'll see. In another week, we might say, well, I can take that off, or put that pretty far down the list. Just prepare. I think prepare and be patient. It may not be a lot to do in the next day or two, except maybe take partial profits in any remaining holdings that you have.
All right. Sounds like a plan, Ed. And I do want to mention that coming up, speaking of planning ahead for the week, Harold Morris is going to be my guest on Trader Tales with IBD at 5 p.m. Eastern. And we are going to be talking about a simple thing that you can add to your routine that can help you uncover new leadership in the market from week to week. So looking forward to picking Harold's brain on that, as well as his take on how we finished up for the week, but digging in a little bit into his routine. So looking forward to all the tips and tricks from Harold. Check out my YouTube channel for that, live at 5, and also on my Twitter feed. We'll also be posting it to investors.com/videos. Thanks so much, everyone, for tuning in. We will be back here next week. Hope you have a great long Labor Day weekend.